What's going on, y'all? Hope all is well. Another episode of Combos with the CFP Mario Payne in beautiful Jacksonville, Florida. I told y'all, the Fed is signaling that they're going to lower rates next year. Most banks think that's the case. So my baby love, TMF, right? A little bit of juice with long-term treasury bonds. That thing is moving. We'll get to what people say and why still TMF might be a long-term investment for people who want some juice on the upside with treasuries. Let go. But before we get started, as always, like, subscribe, share our channel. We continue to grow. Almost 11,000 followers on Instagram at Painful Profits. Checking out because our profits can be painful, but they are profits. But let's go over Fed rates.
The U.S. saw robust job growth in November. That's right. The latest jobs report indicates the U.S. labor market remains solid despite.
Who talked about a soft landing? Who's talking about a recession? Solid. Bidenomics. Or is it? Whatever, though.
High interest rates. The Labor Department reported today employers added nearly 200,000 jobs last month. That's about
up 150,000 October, almost 200,000 November. It's booming, y'all.
A 25% jump from the month before. Additionally, the unemployment rate in November fell to 3.7%.
Can y'all believe we're under 4% unemployment? For every 100 people who wants to work, 96 people are working. Now, we should be getting paid more. Understand that. But wow.
There's a slight drop from October. Gina Smilik joins us now. She is a Federal Reserve and economy reporter for the New York Times. Gina, good to have you with us again. So interest rates still above where the Fed would like to be, also above where any credit card holders would like them to be. But tell us how the labor market has been able to not just weather this year, but has continued to grow.
Yeah, this has been a really surprising outcome. I don't think this was on any economist's bingo cards.
I ain't gonna say anything. Go ahead, Jennifer. What you gonna say? Bingo cards? How old are you? Come on now.
Coming into this year, people thought that the labor market was going to slow pretty substantially given how high interest rates have gone and how quickly the Fed moved them up. But what we've really seen is a lot of resilience. And there's a good reason for that, which is that consumers are still spending, businesses are looking at that and saying, we need to expand in order to meet.
We're still spending. We are a consumer economy. And when we spend, that drives up inflation. But since we are in a deflationary time period because how much rates we rose so far this year, we have the best of both worlds. A growing economy and a growing long-term treasury, my baby, TMF.
This demand. And so we've seen this sort of virtuous cycle playing out. It's really surprised policymakers. I think people are feeling pretty good about it, though. It suggests that we might be able to get this sort of miraculous soft landing where inflation comes down, but the economy doesn't fall into a recession.
So, Gina, it's interesting.
Look at that, y'all. From January, having almost 500,000 jobs added, you think, okay, too much. But every single month, we continue to add jobs, man. The economy's reluctant, y'all. You can say what you want. It's reluctant.
Economists predicted a slight jump because.
Not reluctant. Whatever that R word is, it's doing its job.
This is the end of the auto workers and actors strikes, but this was higher than expected. So I'm wondering how those job actions impacted the November report.
Yeah, that's a great question. So the fact that those two major strikes came to an end almost certainly did push this number up. Economists are thinking somewhere in the range of 40 to 50,000 of the jobs that we saw.
Wow. Man, kudos to the actors, the producers, the writers, man, for putting their foot in the ground, getting more money, definitely making sure that automation and ChatGPT won't take over their jobs. I mean, it sucked for a few months, and hopefully they was able to not be in debt. But long term, striking, fighting for your right, always good for the worker.
This report came from the end of those strikes. So it definitely moved things higher, but we still saw pretty strong hiring even outside of that. We saw very good hiring in sort of the healthcare industry. We saw pretty strong state and local government hiring. So it does seem like some other sectors that don't have much to do with the end of those labor strikes did see continued jobs growth in the last month.
So we got job growth, but we also got the Fed thinking about lowering rates as early as March 2024. So what does that mean for my baby, TMF? Well, my profiteers, I've been talking about TMF for about 4 months, right? I told you guys back in September, hey, this is going to, well, August, it's going to happen. You know, rates are now historical 40-year highs. Mortgages went as high as 8.1%, 40-year highs. It's going to go back down. We just don't know when. So what can we do to profit from that? Well, we can do long-term treasury bonds, right? Long-term treasury bonds went down dramatically, right? TLT, the conservative way to do treasury bonds, went down by 50%. My baby TMF, it is aggressive. It's aggressive, but it went down by 90% from 2020 to a few months ago. 91%. What does that mean? It's going to go back up. Now, will it go back up to where it was? We don't know, but look here. Told you guys as it was going down and down and down. And look what happened, right? For my clients, we actually got in late October. And do we look like a genius right now? Yes, we do. Look at here, right? Literally, late October, right? We got in again. Late October, not at the bottom, close to it, but already my profiteers, 42%, literally in 2 months, right? Market average is 8% a year. Man, clients made in 2 months more than the market makes in 6 years. And as investors, this is exactly, Ghostsmith power. But as we can see, though, y'all, we're green now. What does green mean? We're trending up. And as I always say, 2 things we look at. We trend up, number 1. But number 2, we want to have that golden cross, right? We want to be over that EMA, the average stock price. We want to be above that. And look at here, my weekly chart, my profiteers, we're there. We're there. Confirmation is a week. So at the end of this week, if we're still there, I'm not telling you what to do. But I know for me, the money I had on the sidelines with a half, because I already did half in TMF, we going in. But already, though, like I said, profiteers, we're up like crazy. 45%. But guess what, profiteers? If fifth was the fifth, right? And we ain't getting drunk, nuh-uh. We got our head on straight. I believe, me personally, that rates will get back to where they were in 3 years, where they were 18 months ago, April 2022. So not back to where they were in 2020. And not quickly either. I'm thinking 3 years. So we're going to slow walk this thing, my profiteers. But if we do, look at what happens, right? Bang. From today to where we were again 18 months ago, April of 22. Wow. Pretty good, right? Oh, sorry. My bad, y'all. My bad. Let's go back. Let's go back. We're looking at 140% return. I don't know about you guys, profiteers, but getting back to where we were, being up 140%, pretty good. Remember, I already made almost 50% in 2 months. So 140%, again, the market average is 8% a year. My profiteers, basically you make in, I say 3 years, give or take, what the market might make in 8, 9 years, 10 years, right? With compounding interest closer to 11. So a huge opportunity. Now it is risk involved, right? Because this is leverage, because we want to get it because we think it's going to go up. So we want to take advantage of it. So if it goes down by 1%, you're going to lose 3%. If this goes down by 10%, starts correcting itself, you're going to lose 30%. So very, very important. Be diversified. Don't put all your money in this. Don't even put half or 25%, right? Be diversified. Talk to your CFP. I'm a CFP for my clients, of course, but talk to your CFP. But this is something that you want to look into for the long term, not the short term. Because if rates continue to go down per the Fed and the job market continues to go up, it's going to shoot up. And if it shoots up, so is our portfolio. They could be painful when it comes to our profits. But in this case, profit. So my profiteers, what do we think? We in TMF? We think we missed the boat? We think that rates are going to go up again, or they're going to continue to go down? Comment below. Let me know what you guys think. But as always, love is love. Let's make some paper profits together, y'all. Peace.
And you just wanna get paid, tired of making the money mistakes. Make a payment on your bills and you still late, yeah. Pay for profits to help you seek change, and you just wanna get paid, yeah. Tired of making the money mistakes. Make a payment on your bills and you still late, pay for profits to help you seek change, yeah. Cut the show and just listen. You wanna feel empowered by making money decisions. Residual by the hours can get you a better living. Been check to check, you know, and it could be different, you know.